In this video, we'll be going over the exclusion limit worksheet that you can find in IRS publication 523, Selling Your Home. So this is worksheet 1 of publication 523, and this helps homeowners uh, calculate the exclusion limit if they need to uh, calculate a partial exclusion. So first, we'll go over the rules under the Internal Revenue Code. It's under Section 121, and for most people, it's called the exclusion. Basically, you're able to exclude a certain amount of the capital gain from the sale of your primary residence if you meet certain ownership, residence, and look back requirements. And we're going to go over that a little bit in depth because most people know about being able to take the maximum exclusion, but it's not a binary situation. Even if you're not eligible for a maximum exclusion, you still might be eligible for a partial exclusion. So we're going to go through that as well. So the top of this worksheet, Part A, talks about the maximum exclusion. So let's talk about the requirements for the maximum exclusion. So there are what's known as the ownership and use rule. The ownership rule means that a homeowner must have met the ownership criteria where you've owned the home, not necessarily used it, but you've at least owned it for 2 out of the previous 5 years. And when the IRS defines 2 out of the previous 5 years, they can actually get as specific as 730 days. So be very specific when you are calculating your days, and you're somewhat close. 2 years means 730 days, not 729, not 728. So that's for you to have owned the house, and then you have to have used the house as your primary residence, your principal location for, again, 2 out of the previous 5 years. Now, there are certain criteria, or there are certain situations in which a homeowner may extend that period of time longer. For example, military service members, members of those of the uniform services, to be specific, have access to what's known as a stop the clock provision, where you can actually extend that period of 5 years for as long as 10 additional years. And you would do that if you were on permanent change of station orders. So if you bought a house, say in Norfolk, Virginia in 2015, and you lived in it for 2 years in 2017, and you got reassigned to a duty station, let's say San Diego, California. And from 2017 to 2023, you lived in San Diego, but then you moved back to Norfolk in 2023. You decide to sell it in 2024, you would still be able to exclude the capital gain because the time that you spent in San Diego was less than 10 years, and you can remove that part and still meet the criteria to exclude your capital gain. So the ownership, the residence criteria, and then there's a look back requirement, which means that you can't have taken this exclusion on another home sold in the past 2 years. So you can only use this every 2 years. So that's the look back requirement. Now, for married couples, both spouses have to have met the residence requirement, but there may be situations in which one house owns the house, or one spouse owns the house. Maybe they owned it before they got married, and they don't necessarily need to share the house jointly with the other spouse. And then also in cases of divorce, that also there are ways to kind of mitigate that. So, but generally speaking, most taxpayers that I've talked to know that each person would be able to uh, exclude up to $250,000 of capital gains. So a married couple filing a joint return would be able to claim up to $500,000. And then, a single person or a married filing separately would be able to claim $250,000. So the other consideration that I would say is that a lot of people might not properly calculate the amount of your capital gains. So, technically, your basis of your house is not related to your outstanding loan balance, and it's not related to just how much you paid for your home, although that's kind of the starting point, how much you paid for your home. But you can also add any costs to closing. So if you had to pay additional fees, if you had to pay for inspections, all of those can be part of what's known as your basis. So if you think of your basis as, you want your basis to be as high as possible so that when you sell your house, there's less room for taxes to be applied. So if you bought a house for $400,000, but you paid $20,000 worth of closing costs, then your basis in that house would be $420,000, not $400,000. But then also, as you own a house, as you make improvements, there are certain improvements, that you may think are repairs or maintenance related, but actually improve the quality of your house. So if you replaced your air conditioning unit and you replaced it with a higher SEER unit, for example, if you replaced your roof with a superior roof, those are all things that you can add to the basis of your house. So not to go into too much detail, but if you took your $420,000 house and made $50,000 of improvements to it, your basis is now $470,000. So then, on the back end, when you sell the house, you can deduct any costs related to selling the house. So if you sold it for $1 million, but you paid $50,000 of worth of realtor commissions and closing costs and other fees, then your proceeds should actually be $950,000. So your $950,000 minus your now $470,000, gives you a total possible profit of $480,000. And if you're a married couple filing a joint return, and if you meet the exclusion criteria, all of that gain is now excluded. Whereas if you simply took $1 million of sales price and $400,000 worth of this is what I bought it for, and you come up with $600,000, you might erroneously be paying taxes on $100,000 of capital gain that you did not need to pay taxes on. So I say all of this in a long-winded manner to highlight my point that, in a year where you might pay 15% of capital gains, $100,000 of capital gains, and you paid $15,000 unnecessarily, whereas you could have maybe hired an accountant, paid them $500, and they could have helped you calculate the proper gain of your house so that you didn't pay any taxes on it. So, I usually tell people, if you sell your house and you have, some questionable circumstances, if you are not 100% confident that you can exclude the gain, you should absolutely hire a tax professional to help you calculate what gain, because they'll know what to look for. They'll know the documentation that you can provide to minimize that amount of gain. And odds are, if you don't know this information, that accountant could be saving their year's worth of tax preparation fees on this one transaction. So it is very important that you know what you're doing. So let's go to the bottom of this worksheet just to kind of maybe highlight what you can do if you're calculating a partial gain. So what we're going to do is focus on this part B, and this is where you would complete if you've determined that you're not eligible for the maximum exclusion, but you might be eligible for a partial exclusion. So you would use this section to determine what your exclusion limit is. So in step 1, you're going to determine the shortest of 3 periods: your ownership, your residence, and the time that elapsed between that sale and the last time you took the exclusion. So again, 730 days equals 2 years. So in lines 1 and 2, the ownership and residence rule, there's no question about that. However, it appears that in this situation, 500 days has elapsed since the last sale, which means you can't exclude 100% of what you would be entitled to. What you can do is take the smallest period, this 500 days, divide that by 730. If you use months, you could divide it by 24, but if you use days, it might be a little bit more exact, and it might give you a little bit more credit of a benefit of the doubt. So we come up with a decimal of 685, and then we multiplied that amount by $250,000. So the reduced exclusion went from $250,000 to $171,233. So if you're realizing a gain of $100,000 or $150,000, you're still in the clear. So good news. If you're a married couple filing jointly, you wouldn't multiply this by 2 automatically unless you know that your spouse meets the exact same criteria. So if you and your spouse are operating as a unit, you both lived in the home for the same amount of time, you both own the home for the same amount of time, and you both went the same amount of time between home sales, then you could multiply this by 2. But the default is that the IRS assumes that you and your spouse may have 2 separate backgrounds. So let's just imagine that they don't. Both spouses are the exact same situation. So this basically comes down to doubling the amount. After I just told you we don't automatically do that. And then we're going to carry this number down here. So only the gain in excess of that amount is taxable. Now, all of this is, kind of a moot point if you ever use your home for business or for rental use, because then you would have to factor in depreciation. And if you're selling a property where you did have partial rental use, I will 100% always recommend that you hire a tax professional to do this. I'm a tax professional, and I hire a tax preparer every year just because I know my limitations, and I might be able to make all these calculations, but I know that I could definitely do them incorrectly in a number of different ways. So I hire a tax professional to keep myself honest, and in situations where you have to calculate a gain or recapture depreciation from business or rental use, I definitely recommend you use a tax professional in that year. So that's all we have for this video. We'll put links in the show notes to certain articles that I think might be pertinent to you if you are selling your home in a given year. Definitely, if you do have a capital gain, you would report it on IRS form 8949. You would also report the gain on Schedule D. And if you need to calculate or recapture depreciation, then you probably would need to know how to do that with the proper form. So we'll put all of that information in the show notes for you. So if you like our articles, please subscribe to our newsletter. If you like our YouTube videos, please subscribe to our YouTube channel. And if you have any questions or comments, or if you have an idea for an upcoming upcoming video that you'd like to see discussed, a question or a topic, please hit me up in the comment section. Thank you very much and have a great day.